This is Fintech Insider News. This week, losses from e-commerce fraud globally could hit $100 billion by 2029. London IPOs could be stalled by sluggish investment growth. And Zopa releases the first impact report from its Fintech Pledge initiative. We speak to Zopa's Chief Customer Officer. We'll be discussing all of these and more on today's show. Hello and welcome to episode 905 of Fintech Insider. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. I'm joined this week on Fintech Insider News by three great guests who are here to break down the biggest stories in the past week in fintech and financial services. First up, it's a Fintech Insider debut for Joshua Vowles-Dent, Business Strategy and Partnerships Manager at ComplyCube. Welcome to the podcast, Josh. Can you tell us a little bit about yourself and the work you're doing at ComplyCube, please?
Of course, thank you. Hi, everyone. Thank you for having me on the podcast. It's a genuine honour to be invited on. I can't wait to discuss some of the topics you've picked out. Very relevant topics to what we do as an organisation. So what is that? I guess, so ComplyCube we're on a mission to build trust at scale. We're doing that by building solutions that secure the digital interactions between companies and consumers online. Our end-to-end platform leverages state-of-the-art AI, no-code automation, and global data coverage to verify identities, prevent fraud, automate onboarding for both businesses and individuals, and ensure regulatory compliance globally. As my title suggests, I work across the business to define our overarching strategy and deliver on it through our sales, marketing, and partnerships efforts.
Well, welcome. Next up, we have a warm welcome back to Fintech Insider for Clare Gambardella, Chief Customer Officer at Zopa. It's great to have you back on the podcast, Clare. Zopa's evolved a little bit over the years. Perhaps you could remind our listeners, or particularly listeners outside the UK, what Zopa is. And your role as Chief Customer Officer is fairly obvious, but perhaps you can tell us a little bit about what Zopa's up to.
Sure. Thanks for having me back again. So Zopa is a UK-based digital bank. We have been a fully regulated bank since 2020. We provide a range of products, mainly in the lending and saving space, and we aim to provide great value and transformative ease for our customers. We serve around 1.3 million customers in the UK today, and we are soon to move into the current account space as well. So lots of news to come there. My role as Chief Customer Officer really oversees a few different areas: marketing and comms, as you would expect, also product design and customer lifecycle, so the way that customers move through our various products and interact with Zopa once they are inside of the business, in order to give them a hopefully slick and seamless experience.
Fantastic. Well, welcome back. And we're also delighted that we have another Fintech Insider debut for Paul Clarke, Chief Growth Officer at Cashflows. It's really great to welcome you onto the podcast, Paul. Can you also tell our listeners a little bit about the work that you do at Cashflows, please?
Yeah, hi, everyone. Great to be here. Looks like it's been a really interesting week in terms of stuff we're going to talk about as well, so can't wait to get into that. So Cashflows is an independent acquirer stroke payment gateway. So our main MO is providing payment capability and payment facilities to small businesses, effectively enabling them to take payments online in face-to-face environments, and to do that in a kind of safe and efficient way, trying to get the most out of payments to help them grow their business. We do that in the UK and in Europe. As I said, we tend to focus on the smaller to mid-corporate customers who are looking to take payments. As Chief Growth Officer, I look after most of the commercial aspects for Cashflows, so our sales, account management, product and marketing efforts across the business. And it's great to be here.
Well, welcome. Okay, well, let's move on to the news. So our top story this week is that e-commerce fraud has been predicted to exceed $100 billion worldwide by 2029. That's an increase of 141% from the estimated $44 billion this year, 2024, with artificial intelligence boosting the sophistication of these financial crimes. This is all according to a study by Juniper Research, whose paper looking at the next 5 years of financial crime sees the advancement of deep fakes as a central threat to both consumers and financial institutions. The report finds that artificial intelligence can not only enable attacks at a greater scale, but also with higher levels of detail and realism. Josh, let's bring you in first. This research paints a fairly bleak picture. Are you sort of surprised by their estimate of the scale of this risk?
Not at all, I'm afraid to say. Something like 1 in 4 leaders aren't even aware of the threat that's posed. But I also don't think that means there isn't hope. But it's up to us to kind of try and work together to change those stats as an industry. E-commerce is a sector that hasn't really seen any significant evolution when it comes to fraud prevention, at least not in the same way as you've seen in financial services and some of the technology and solutions that are being implemented. So fraudsters have been able to exploit that gap in the market, and will continue to do so until technology is implemented to combat those threats in that particular sector. And it's like any sort of situation where you have threats across AI frauds and deepfakes across any sector. It's not just about that one point in the customer journey, it's about the entire customer journey as well. So you have to really secure that end-to-end to be able to prevent against these deepfake and AI attacks that are being presented by criminals.
Paul, I'd love to bring you in. Did you sort of agree with Josh's perspective that a lot of merchants maybe aren't ready for this and haven't really been thinking about this, or are you hearing different things from some of the merchants that you talk to?
Yeah, I mean, a lot of the merchants we talk to already implement a lot of tools and are always trying to get that constant battle between how do you make sure you're providing the right kind of tools to prevent fraud, but at the same time ensuring that the consumer or whoever you're selling your product to has a seamless, frictionless experience, and the experience is as good as possible. So getting that balance right is always key. I mean, unfortunately, I've been in this business for a long time, probably 20 odd years, and this has been a constant battle, not just now. I mean, ever since I think money was invented, fraud's been there and thereabouts, and so it's a constant battle to continually be thinking how can we, keep up really with this remarkable, innovative industry, which is fraudsters who are brilliant at trying to, use systems and tools to part with people from their money. So I think by and large, retailers are aware of it. But I think ensuring that we're constantly thinking about what are the right tools that we can use at the right time, trying to stop fraud at source seems to be key. But I think there's always more that we could do. Weirdly, since the introduction of the 3D Secure 2.0 18 months ago, we've actually started to see quite an improvement in online fraud as a result of some of the checks and balances that were brought into place as part of that. That gives us some hope. And I also see a lot of what the schemes, Visa, MasterCard are doing and the investments they're making. And, as much as fraudsters are investing in trying to part us with our money, I know the schemes are working really, really hard to try and stop that happening, using AI to prevent fraud as well. So hopefully at some point we can have AI fighting AI to stop fraud happening and none of us will need to worry about it.
Josh, I'd love to bring you back in before we bring Clare in. As sort of one of the arms dealers for the good guys in this battle, as Paul puts it, can you how much of your time do you spend at sort of ComplyCube thinking about the risks of AI, and what are some of the things that you think can be done to try and combat AI powered fraud?
Yeah, so Paul picked up on a couple of really good points there around this constant battle, and we are constantly thinking about it, and we kind of have to be able to stay ahead of the fraudsters. To his point, organizations and fraudsters are in this it's kind of a constant loop of cat and mouse, trying to stay ahead of the other, and you have these kind of client side protections, which is basically your first line of defense, but with any sort of defense against AI, you need to, as I mentioned earlier, have sort of an end-to-end view of it. And I'd also say that we are also in a situation now where we have AI fighting AI. So that's basically what we're doing at ComplyCube with a lot of the solutions that we're developing. And so you have to be constantly training those models to try and stay ahead of what the criminals are coming with. So we use something called GANs, which is generative adversarial networks, which is a sort of AI's proxy to cat and mouse, where we're constantly iterating, training those models, become smarter and smarter. And we have obviously a whole raft of clients which are using our solutions, and without sharing any information or data back to us, they are like, their models are being trained as they onboard customers and put them through, for example, our biometric and liveness detection systems. And whether they identify a particular fraudster, for example, or someone that's trying to penetrate one of our systems, if they identify that and they reject them, that trains our model to get smarter and smarter. And so we're trying to stay ahead in that sense. And so in terms of like the models, we basically, like, you kind of identify particular markers so that maybe are also visible to the human eye. And so a lot of these AI deepfakes, even though they might look like a human when you're speaking to them, actually there are markers that are part of the presentation that they've presented with you that kind of leaves a signal that the model can then start to pick up on and focus on that particular marker, and then identify that, and then identify new markers as that develops and gets smarter as well. So it's a constant loop, and you need to have a sort of multi-layered fraud prevention stack. It's not just about the biometric model, it's about everything that kind of goes behind that and looks at the overall behavior of this individual and their transactions, for example. And looking at other things, sort of like their IP address. Are they in the location that you expected them to be in? All the device intelligence that you can gather from how that was submitted. And so it's about using all those data points and creating a rounded picture of the client or the fraudster to be able to come to a conclusion. And then the more the adoption there is of these pieces of technology more widely, the more as an entire ecosystem will become stronger at fighting against them.
Thank you. Clare, I'd love to get your perspective on what this means for customer trust, because we tend to think of sort of, the advance of digital commerce as sort of, one-way thing where, gradually everyone's getting more and more confident and happy using, doing everything digitally. And yet, does AI threaten that? What do you think this means for customers?
I think firstly, it's a very tricky problem because our focus, or the focus of the industry in many cases in the past, has been about educating consumers for signs to look for, to be aware of fraud. And as we move into a world of AI, those signs, as Joshua just touched on, are much more nuanced, if actually indeed there at all. So I think that all of the ways that we've thought about consumer education and building consumer trust in the past is going to have to move on, because it's much more difficult for the consumer to actually spot these issues. I do think that one of the things we need to think about is the platforms and the responsibility that they take. We've talked a bit about merchants, but actually a huge amount of fraud also originates, as we know, on social media platforms, which are also becoming much more of a kind of e-commerce platform as well. And so I do think that there needs to be a more concerted effort across the industry and by the social media platforms to think about how they take responsibility for the type of content that's published, the type of behavior that's happening there. So I really think it has to be not only a merchant issue, not only a bank issue, but actually the issue of many of the platforms where fraud is being perpetrated. And that's a very tricky thing to solve. But so far, there are very few measures in place that allow the platforms, or that suggest that platforms should take responsibility for this. And I think that that's going to have to be a discussion in order to build consumer trust, because I really don't see how else consumers can spot some of these frauds. So it'll be interesting to see how it evolves.
Paul, sort of last word on this story for you. Do you agree with what Clare has been saying? And do you think there are sort of groups of merchants that might prove particularly sort of vulnerable to this type of fraud?
Yeah, and I think interestingly, it's just from what we were talking about there, the the type of payment also lends itself some more to fraud than others as well as types of merchants. And I think we see, from the research you quoted, some of the larger merchants tend to fall foul sometimes to the fraud that we're talking about. We don't see any particular. There are certain industry sectors or certain types of merchants who are just more susceptible because of the type of goods that they sell or the payment types that they take, for sure. I think we tend to see cards having less of an issue right now, maybe because there's more protection and solutions that have been put in place. That doesn't mean to say there isn't an issue, but I think in terms of the growth that we've seen in levels of fraud, certainly we've seen a lot more of that growth in push payments. Obviously, with this week's quite topical with everything that's been happening this week around the push payment side of things. So yeah, as ever, I think it's interesting. Just going back to the original question around, we're seeing potentially fraud growing to $100 billion by 2029. We're also going to see e-commerce grow by another $4 trillion in that time. So it's going to grow to $11 trillion by 2029. So yeah, absolutely. It's a horrible statistic to think that the fraud's going to be growing at 3 times the rate we currently see it. To somewhat, that's probably in line with just the growth generally of commerce that's going to go rather than face to face. But just going back to the original point, it's a constant battle. In 10 years' time, we'll be talking about this. In 20 years' time, we'll be talking about this also. And we're constantly just trying to see what are the things that allow us to stay ahead of that.
Thank you for ending that on a really strong positive note. Now, interestingly, Clare's point about the social media companies and the potential need for some kind of sort of regulation, it brings us very nicely into our next story, which is that Fintech Australia is backing government scam protection as the UK government is pushing for transaction delays. And these were reported in the Fintech Times and FinExtra. So while the technology underpinning financial crime is getting ever more sophisticated, governments are scrambling to try and stem the threat. So the trade body Fintech Australia has backed the Australian government's new Scams Prevention Framework, which is set to impose tough preventative rules across the sector. These measures include regulatory sandboxes to test resilience, as well as a more precise definition for scams. Meanwhile, in the UK, the government is currently planning new powers to intervene in suspected fraudulent transactions by holding up payments for up to 72 hours. This comes in the same week that the UK payment system regulator has introduced its new mandatory reimbursement scheme, which is what Paul was mentioning just a couple of moments ago. Josh, maybe back to you. What do you make of these Australian anti-scam measures? Do you think those could be effective?
Yeah, so potentially. I think it's still early days. I think what you've seen in the UK is a lot of very sort of tangible measures that have been put in place recently. I think this kind of movement is typical of a more widespread global movement that we're seeing in that sort of direction of sort of organizations and institutions and governments starting to work together more to help try and prevent scams and fraud. I do think there needs to obviously be more of this type of collaboration, and we're kind of seeing it around the world, but it seems to be kind of feels a little bit late in the day in some ways. Like there's been a lot of fraudulent activity been happening for a long time. And again, as usual, governments and legislation is behind a lot of the technological advancements that's happening out in the market. And sort of now they're, I guess, trying to play catch up around that. But yeah, it's positive. It's a good move in the right direction, I would say.
Claire, what's your view here? I think sometimes we see banks sort of getting a bit of the blame and certainly, having to sort of carry the costs of fraud in a system. You often see banks in various different countries around the world sort of being expected to compensate customers for frauds. And obviously there are things that banks can do, but is that entirely fair? I mean, maybe you'd have to take off your Zopa hat for a moment and just sort of talk in general rather than about Zopa specifically. But is it fair that the banks sort of sometimes have to sort of carry the can for fraud in a system?
I mean, I think fraud is an industry-wide problem, and it's a really distressing problem from a consumer point of view because it has not only financial but also psychological impacts, which are extremely severe. And, I think that obviously certain consumer protections are needed. I think that it is fair to say, though, that given that I believe 90% of fraud originates either through telcos or through online platforms. That even if banks are really advanced in the way that they deal with these things, generally we're trying to stop the fraud once it's already in progress. Right, we're trying to say to the consumer, are you sure you want to make this payment? Are you sure that these payment details are right? Have you really thought about this? So at that point, the consumer is already in the fraud. So even if it stopped at that point, some of that psychological impact is there. And sometimes, those things don't get stopped, they don't get caught. So I do think that going up the chain, as Australia is suggesting, looking to telcos, looking to the online platforms to take some responsibility is really, really important. I also think it will help, as I said before, to build consumer trust in those platforms. I think that one of the things we also need to consider is the fact that these things need to be implemented in a really proportionate way. So what you definitely don't want is to create an experience that's so painful for customers, especially in certain types of payment channel, for example, as Paul mentioned, that actually they just either stop using those channels, it holds up transactions which are actually valid and causes friction and potentially detriment there. So I think that the devil is going to be in the detail of implementing these things. But broadly, I think it's a really, really positive move to look at the whole ecosystem rather than just cherry picking points in the journey.
What's your view, Paul? Do you agree with that?
Yeah, I do. I think it's great to have more consumer protection for certain types of payments than we have had of recent. So I think a lot of the changes are in the positive direction. It's also a balance as well, isn't it? Which as I sit and think about it, and just I don't have the answers, but when I think about, to Claire's point, I think one of the most important things is consumer education at the very beginning, right? Because that's the point, I think, where you're going to have the best opportunity to stop fraud happening in the first place. And the more educated we can make people, the more educated we can talk to people about that stuff, that will absolutely help. And then, but then if you take away the barriers and actually take away the penalty almost of fraud, if that's do people become complacent and actually then don't start to worry about the education piece because they don't need to, because they're so well protected behind the fraud that it kind of takes that away. So fine balance there, I think, between trying to make sure that we continue to educate people well, but provide the right kind of consumer protection, where consumers have done all that they can do as well, if you like, to prevent fraud happening in the first place. But yeah, no, I think it's all the steps that we've seen, particularly with the PSR, and I'm probably more aware of that than what's happening in Australia, to be honest with you, seem to be heading in the right direction in terms of trying to provide the right kind of protections for consumers as we go.
It's hard to get guests from Australia when we record at this time of day, but we do sometimes record at different times of the day so we can get guests from different parts of the world. You make a really interesting point there about the sort of moral hazard for consumers if there's too much protection, right? If the bank is going to reimburse me for any silly mistake I make, then maybe I don't worry about it. But I kind of want to pick up on that point that Clare was making about the social media companies and platforms and the role that they have in sometimes maybe turning a blind eye to fraud that's happening on their platforms, or the sort of the promotion of various scams through social media. And obviously there's a vast amount of activity happening on social media every single day. There's an awful lot of things that social media companies and other tech platforms need to look out for. But Josh, do you sometimes see things that the sort of tech platforms can do? Do you sort of see scams that are coming off particular platforms in certain volumes? Do you think there's more of a role that the tech companies could play in stopping the frauds a little bit further upstream?
100%. Completely agree with what Claire said. If you go on some of those social media platforms, it is a little bit of a Wild West. Particularly on things like some of the like Facebook Marketplace, for example, like the interactions, like those peer-to-peer interactions where there's zero protection, you have no idea who you're dealing with. You order something through the marketplace, you give them your address, your name, your email address. Like they've got a lot of information there that they can then utilize to then be able to get into your email, get into your Amazon account, be able to get into your bank account. they're very smart and they're working across the entire ecosystem. So anywhere where there's any gaps, they will utilize it. And so these fraud preventative measures need to be implemented across the system. So, and it's that first line of defense where it starts, which is about being able to actually verify and identify the person that you're dealing with on the other side, whether that's peer-to-peer in a marketplace, whether that's a business interacting with a new customer they're looking to onboard, being able to match the identity that you're onboarding with the person who's holding the device, who's holding the method of identification alongside it. That's critical for that first line of defense. And then you have the other things behind that, which go further up the customer journey, which is around, as Paul mentioned, around the education piece, around the behavior analytics, looking at the device intelligence, looking at how they're using their keyboard. Have they downloaded a screen sharing piece of technology, for example? There's all these things that builds like that full picture that I mentioned. And so, yeah, that's the starting point. So if we can stop it at that point, that gives us a much better stepping forward ahead of the criminals, for sure.
Claire, the last quick question to you. So I noticed this point about the British government trying to introduce as a delay to the payment to hold up payments. We've also seen in the past other banks in the UK and other countries saying to their customers, actually, we're not going to let you move money to crypto, or we're not going to let you move money into certain things because we think the risk to you is so high. Do you think you ever get to the point, not necessarily Zopa, but in the banking industry in general, where you just end up with certain categories of merchants or certain types of transactions where you just start saying to your customers, we're really sorry, but that's just too risky?
I mean, there are certain things that we would not, for example, allow people to use a loan for because we feel like it's really bad financial practice. So, yeah, I mean, I think it's absolutely up to organizations to define, are there rules or parameters that they just feel are so black and white that they are making that decision as a business. I do think, though, that it is tricky because, you have to balance that with the fact that, consumers are adults. You are not there to police their spending or their choices, right? So I think that, those rules or those boundaries need to be few and far between. They need to be, more or less, I think, sort of fact-based rather than judgment-based. And I think that there needs to be a really clear rationale for them, because otherwise that spirals and spirals. And I do think that, some of the, let's say, decisions that have been made recently about how customers are reimbursed for certain things, does open up that question about if customers are choosing to make certain choices, at which point should the banks intervene? Because I think there are some cases where actually, the regulator has said that potentially the bank should have intervened sooner. So I think it's a really hot topic at the moment about where the responsibility of the consumer ends and the bank begins. And I'm sure that it's one that will evolve as both the regulation changes and as consumer behavior changes and as banks think about these things in a really dynamic way going forward.
That's such an interesting set of points. We're going to have to do another podcast just on that, I think, because it's there's a whole load to unpack there. Okay, well, on that note, we're just going to take a quick pause here and we will be back very shortly. Welcome back. Before we dive back into the rest of the show, we wanted to tell you about our latest Fintech Insider Insights show in association with Curve. We take a look at what could be the next frontier in payments, digital wallets. Apple Pay and the Apple Wallet has become dominant in some markets over the past decade, but with the tech giant forced to open up the iPhone's NFC chip to third-party wallets, there's suddenly a lot more room for competition in that market. So we're delving into the challengers looking to take on Apple and innovate in digital wallets. Back to the news. This is reported in City AM in London. The fintech funding squeeze could scupper London IPOs. A report from City AM has found that a number of London fintechs are increasingly pessimistic about IPOs and are even considering buyouts. Although fintech investment in the first half in the UK has risen substantially since last year, with £5.7 billion compared with £2 billion in 2023, funding is still far short of the peak seen in 2021. Industry leaders told the publication that the cash squeeze could produce an influx of fintech M&A activity over the next 12 months as firms weigh up whether to double down or cash out. This report follows the news that TrueLayer's valuation following its Series E funding extension has dropped and that the firm is no longer a unicorn. So, are we about to see a period of mass buyouts and consolidation rather than listings in London? Paul, maybe I should come to you. Do you think we've seen a sort of turn down in the prospects of fintechs sort of coming to the market and launching IPOs? Do you think the sort of enthusiasm for fintech among British investors has maybe dropped away a bit? What's your sense of how the market's evolving?
I mean, it would appear like that on the face of it, because there seems to be a little bit less investment, and there's obviously not been any or as many IPOs around fintech in the last couple of years as we'd seen before. But I'm not so sure that's a bad thing. I mean, I think what we're seeing now is a more kind of realistic approach to businesses looking to generate profits and revenue and become profitable and evolve businesses in that way. So it feels more to me as kind of right sizing as much as anything of the market. I do, I operate in a small business at the moment that is equity funded. I've been in a couple of organizations previously that have been through IPOs and have been equity funded. And then, over the last few years, we've looked at some of the acquisitions and some of the IPOs that have happened and looked at some of the multiples, and you think, how on earth is that business worth that amount of money? How is anybody ever going to get a return in my lifetime on the outlay that they've had to make on a business that's looking like it's generating whatever it is? So there's a little piece of me that thinks, it's pretty much a right size, and this kind of needs to happen to make sure that the investment that's going in goes into the right places and gets invested in the right things, which is building more sustainable businesses that have, medium, long-term future. So I think investing in the right things, there's not really a shortage to do that. I think maybe where we've seen is just that kind of huge rush to invest almost in anything fintech seems to have dissipated. So I'm again relatively optimistic that in a reasonable period of time we'll see acquisition return, we'll see IPOs return. There will be consolidation for sure, but I think it's the market right sizing itself.
Do you agree with that, Claire? Do you think we're seeing fintech sort of being more realistic, being more profit focused, sort of scaling back of some of the ambitions of maybe a couple of years ago?
Yeah, I mean, I definitely think that the heat of a couple of years ago has subsided. Having said that, though, I think that, as you pointed out in the introduction, we are seeing now an increase in investment coming back into the market. And I think that the UK, if I'm right, is still actually second only to the US in terms of the level of investment in the fintech sector. So I think that broadly, I agree with Paul that there's lots of reasons to continue to be optimistic. I think at Zopa, our focus has always been on achieving profitability as a business. We did that last year, which was a pretty fast trajectory. And I do think that that is really important because it means that the business is sustainable in its own right, that where we're seeking investment, it's to continue to grow, faster and greater. And so I do think that shift you have seen coming a bit later across the industry, but it is seeming to be a bigger trend and much more important than it was maybe a few years ago. But I think that's been a very consistent focus for us. I also think that for companies that have focused on building sustainable businesses with strong market fit, then actually this is a really interesting time of opportunity when the market starts to potentially consolidate a little bit. There are a lot of opportunities both in terms of how consumers behave and also how businesses can grow organically and inorganically. So I think this is still a really positive time for fintech in the UK.
I'm conscious that Zopa is one of the UK fintechs that might at some point do an IPO. So I'm deliberately not asking you because I know that's an unfair question to ask a chief customer officer, and probably an unfair question to ask on a podcast in general. But I'm aware that Zopa is a company that might at some point tap public funding. Josh, on this point about sort of consolidation of, so if we are seeing, some fintech saying actually it's going to be quite tough to raise raise funds in this environment. Do you think there's an opportunity for fintechs to merge? I mean, if we take, you take your world, How easy would it be for you to sort of integrate with a rival? You've got a whole load of tech that you've been building for a number of years to enable you to do, all the great things that you do. And then if you suddenly merge with another firm, does that mean you're losing momentum? You're trying to stick together lots of different tech stacks. How easy is it for a fintech to sort of merge with another fintech? Do you think it's a realistic path for lots of businesses?
I think you are actually seeing a lot more of that in terms of the acquisitions and consolidations that are happening. There was obviously the one particularly in our space, which was obviously one of our big competitors. I'm not going to say their name because that would be promoting them. But that happened obviously earlier this year. So you're definitely seeing that consolidation. I think where organizations are looking for capabilities that complement their own, rather than potentially developing them in-house. Where there's cash available, they're looking to be able to do acquisitions. We're seeing a lot more across the market, and it also provides a lot more stability. It can provide a lot more stability potentially than going for an IPO, because you're subject to the volatility of the markets in an IPO. Whereas with a buyout, there's kind of a sort of, you agree a fixed price, and then it's about the cultural and the technological integrations that happen after that, which is the biggest challenge. So yeah, I think there's definitely. Obviously, to Paul's point, as you said, there's a lot of the higher valuations which were really overinflated as well, and so now I think there is more buyouts that are happening, particularly in the regtech space. More specifically, you're seeing that consolidation, and where you've got some of the vendors at the sort of top end, commercial end, looking to potentially integrate some of the more smaller, nimble providers at the bottom ends, doing the more kind of point solutions. They're looking to enhance their products with those point solutions to build out more sort of end-to-end solutions that can tackle more problems in the market as well. So yeah, it's an interesting time, but it does feel, agreed, that it feels like there's more of a buyout phase at the moment than an IPO phase in some areas.
Paul, I'm going to throw a slightly unfair question at you. There's a bit of a sort of London, New York thing going on in this story of, are British businesses going to go to New York to list and to try and raise funding from the larger capital market there, or is Clare right with her point about actually London is still a fantastic financial market? What's your view on sort of New York versus London?
Ooh, that's a political question. I'm not sure I want to get into that one, but I think, do you know what, interestingly as well, because we've looked at this, and I've looked at this in previous organizations, and we have customers and partners who are maybe at that inflection point and thinking about that same question as well. And it's not just necessarily where the best opportunity for that particular round of funding, whether it's an IPO, whatever it needs to be, whether it's London or New York. There's a lot of other things to consider about the ongoing regulatory regime in each of those countries, and what would that mean to that business? Would it still provide the runway and the framework that business would need to operate in, whether it's New York or London? And there are some big differences in terms of what it would take to run, particularly in fintech, particularly in payments, how those businesses are regulated. And so I think something that might look attractive, say, to list in New York for financial and economic reasons, ongoing in terms of running the business, may not actually look the same. The same could be true the other way around. So I'm going to sit on the fence and say that either of those are great options, but I think it depends on the business, and not just the funding point of the business, but the ongoing running of that business and what they're trying to achieve, I think, in terms of what's the right place to list.
I think you gave a very good answer, even though you did sit on the fence. But Okay, well, we've discussed some fairly existential technological threats and economic threats to fintech and indeed consumers. But now we want to move on to a brighter news story, which is that Zopa Bank has released the impact report from the 2025 Fintech Pledge. To mark the second anniversary of the pledge, Zopa has unveiled its first report on the impacts of the initiative. Zopa has now hit 18 million consumer actions, 70% of the way to its target of 25 million by the end of next year. The Fintech Pledge was launched by Zopa and ClearScore in 2022, with the aim to boost public engagement in 5 key financial pillars: savings, credit, debit, bills, and benefits. The pledge has brought together a wide range of partners from across fintech and the broader tech sector, with major signatories such as Google Cloud and Salesforce. So we're delighted to be joined by Clare from Zopa. Clare, you're 2/3 of the way through the life cycle of the Fintech Pledge. Are you happy with the progress?
We are delighted with the progress, yes. We'd initially set out to reach 10 million actions by the end of 2025. And actually, by 2023, the end of 2023, we increased our goal to 25 million because we had already made a significant dent in that 10 million at that point. We've now, as you said, reached 18 million actions, which is about 70% of our goal, and we've got a year to run. So we're very excited about that. I think, though, that while the actions are really important, the impact report also touches on some of the broader work of the pledge, which is around financial education and increasing access to kind of easy to understand financial resources. The pledge does this through its partnership with the Money Charity and also directly through content stream that we've created on TikTok and social media called Master My Money. So there's lots in the report. I'd really encourage anyone to check it out at www.pledge2025.org for further detail.
Can you give our listeners an example of an action? Because it's a little bit hard to sort of know what an action might be. What is an action by a consumer?
Sure. So the actions are defined for each of the 5 pillars that you mentioned, but an example for the savings pillar would be somebody opening a savings account with one of the regulated firms that are within the pledge who offer high interest savings accounts and moving money into there and earning incremental interest. So over the course of the pledge, 700,000 savings accounts have been opened and consumers have earned £500 million worth of interest. Another example would be somebody comparing household bills and then actively moving to another supplier in order to save money. So it's not just about looking or making the comparison, it's about actually taking the action that will allow you to either gain interest, save money, improve your credit score, etc. So that's how we define actions for each pillar.
So you've had 18 million consumers doing things that have improved their financial well-being, improved their financial situation.
That's what we would hope, yes.
Is that one person doing 18 million things or 18 million people doing one thing?
I mean, that's one busy person, let's be honest. That's my dream customer, just out there doing their financial actions. I mean, so we have not been able to dedupe these actions across platform. So you're absolutely right. You know, this is why we talk about it as actions rather than consumers. What we have done, though, is to talk to consumers. And in the report, you'll see that there are a bunch of testimonials about how consumers have interacted with the pledge, what kind of impact that's had on them. And going and talking to consumers to understand those stories, I think has given us a lot of reassurance that, you know, people are dipping into various pillars in a way that works for them in order to access these benefits. And that's why I think it's important that these 5 pillars really cover a very broad spectrum of how people can improve their situation, right? At one end of the spectrum, you've got, how do I access the right benefits for me? Make sure that I'm not leaving benefits that I'm eligible to on the table. At the other end of the spectrum, you've got somebody who is able to save some money. And how do I make sure that I'm really getting the best interest rate for that and maximizing the amount of security that that can give me? So this is where I think hopefully those pillars have very broad appeal. And so while I'm sure that some people have done more than one action, I'm hoping that we have accessed, a broad swathe of the UK population on this mission.
Clare, I really love what you and your colleagues are doing with this. What are you hoping to have achieved by the end of 2025? So by the time the sort of Fintech Pledge closes, what are your sort of hopes and ambitions for the next year and a half? Well, actually, not a year and a half, a year and 3 months.
So first of all, reaching the 25 million actions, we've got about another 30% of the way to go. So all of our partners are pushing towards that. I think the second thing is that along the way, because we have this coalition of very different businesses, some of them fintech, some of them charities, some of them industry support partners, you mentioned a few of those, who have come together around these actions and this mission, we have seen that actually there's been partnerships and innovation born out of that, and the report details some of those. So I also hope that by 25 there's more of those, because they will be the things that leave the lasting legacy in the industry of collaboration and hopefully better customer outcomes ongoing. The third thing is we will be generating another impact report to look at, are we making sure that this next year and a half actually builds on the progress we've made so far? Did we actually achieve what we set out to do? And I think lastly, really thinking about what's next. We've created what I think is a really kind of unique coalition of these 57 companies. And actually, I hope by the time we get to the end of 2025, it will be more than that, because we're seeing new partners join every day. Well, not every day, but on a very regular basis. I don't want to mislead, but we're seeing new partners join very regularly. And so, actually, what's the next step for how we harness that collaboration in service of the customer? I don't know, but I think that that's a really interesting conversation for us to be having over the next year.
Well, thank you so much for coming and telling us all about it, and keep up the great work.
Thanks.
Okay, now for a quick look at one more news story this week that we didn't have time to cover in quite so much depth. And this is that Cashflows and MasterCard are to bring Clic to Pay to UK firms. This was reported in the papers. So the technology is aimed at removing friction from the checkout process so that the customer doesn't need to enter their card details. Clic to Pay also promises to remove the need to remember passwords at checkout. Cashflows has promised that the tech will come at no additional cost to clients, and that the solution can be embedded directly into merchants' websites, with no need for redirects. Now, we're lucky enough to have Paul from Cashflows on the panel. So, Paul, can you tell us a little bit more about Clic to Pay?
Yeah, for sure. And interesting, Ben, when the conversation you had earlier about the other fintech channel you were talking about, looking at wallets, Apple Pay, this is right in that space, actually. So Clic to Pay operates in precisely the same space, really, as Apple Pay. So Cashflows, it's not Clic to Pay is not a Cashflows product. It's a product that we enable on behalf of our customers. So what Clic to Pay is effectively a wallet solution that's owned by the scheme, so by MasterCard, Visa. And you mentioned earlier that Apple are opening up the Bluetooth piece that sits inside their phones and enables more competitors into that market. I think this is potentially one of those competitors that really could impact the market that Apple and Google Pay have right now. What is it designed to do? So if I think about it in terms of, very briefly, what problem is it solving? So we've talked a lot about e-commerce, the growth of e-commerce, and it's going to continue to grow exponentially. But we still see, even today, a lot of issues with e-commerce, right? So whether it's on a consumer side and then how that affects merchants. So 46% of consumers are still reluctant to have their details stored with a particular merchant. So we'll rather go through a guest checkout than actually store their details with a particular merchant. 75% of those do that because they don't trust the merchant with their personal information and details, and maybe that's understandable given some of the conversations we've been having around fraud and potential fraud today. And 70%, based on the last numbers, of e-commerce transactions bail before they actually get to conclusion. So what we call basket rate abandonment. 70% of all transactions that are started are still abandoned before they actually make it through. So from a merchant business point of view, all of those things are not helping us grow the market, are impacting their ability to sell stuff. So if you can solve some of those things, which is effectively what Clic to Pay and I guess Apple Pay are aiming to try to do, that certainly helps. So Clic to Pay, it's really simple to enroll. It's a product, I say, that's owned and developed by MasterCard and Visa in conjunction with EMV Co. So it has all the latest standards, complies with all the latest standards, and basically just makes it very, very easy for consumers to enroll in the product. And then once enrolled in the product, you effectively just use Clic to Pay to check out wherever you see the Clic to Pay logo, whether it's on a mobile device, whether it's on your laptop, any e-commerce kind of environment. So it provides a agnostic checkout capability across multiple devices, really simple to use, and actually brings the average transaction time down we noticed in the early stage transactions that we've been operating under to probably less than 2 seconds. So that's from the point when I say, I'm interested in that, I'll press buy. Actually, I can complete that transaction in 2 seconds with information that's stored in a secure way, protected by the schemes. So I think goes a long way towards answering some of those questions and some of those problem statements around how can we still continue to improve the experience for consumers in an e-commerce point of view. So
there'll be a sort of logo, a bit like the PayPal logo or the Apple Pay logo, as you say, on lots of merchant checkouts. And if I've already registered for it once, it'll recognize me presumably from my device.
Yeah, absolutely. So if you've already registered once, it'll pop the logo up. You can just hit the button and check out. If you haven't registered, you can register during the transaction. It's really easy to enroll with doing it. It takes a couple of seconds to do that. And then you're off and running effectively. And although it's sponsored by both schemes, it doesn't matter which cards you want to put in there. There's no restriction on whether it's a Visa or a MasterCard or even an Amex card. It's agnostic of all of those things.
And when can listeners in the UK at least expect to start seeing this on checkouts, or indeed listeners in other countries?
Yeah, well, I think it's been rolled out over the last 12 months or so. So I think we're starting to see more and more of the logo appear on more and more websites. I think this is this next few months and the coming year is where I think there's been a lot of beta testing and testing of it to make sure that the product works and delivers on all those promises of speeding up transactions. I know both MasterCard and Visa are investing heavily in awareness, making sure that the logo, the checkout functionality is available in as many places as possible, and also from an issuing side, that your issuing bank are giving you the opportunity to enrolling it as easily and as quickly as possible. So I'd say probably over the next 12 months, we'll start to see a significant increase in the availability, awareness, and therefore usability of the Clic to Pay product. And I guess it remains to be seen what impact it has on Apple Pay and Google Pay and the march that those guys have got. But for us, anything that adds to that consumer journey, the ease of doing it, simplifying, securing it, just makes perfect sense. So it'll be interesting to see how that pans out.
Well, fantastic. Thank you for telling us about it, and best of luck to your team. I look forward to seeing it on a checkout nearby very soon.
Checkout near you.
Okay, and finally, let's have a look at something a little bit more lighthearted from the world of finance, which is that Bank of Ireland is introducing startup Standup to integrate comedy into pitches. The bank has enlisted the help of comedian Sharon Mannion to help Irish founders make their funding pitches stick out with techniques from the world of stand-up comedy. This free workshop has been developed in partnership with the VC firm Delta Partners. Amy Neal from Delta Partners says, fundraising is a serious business. You need to be a storyteller, an influencer, and a performer. So, panel, do we think fintechs have a thing or two to learn from the world of comedy? Josh, do you think comedy's got a place in startups doing their pitch?
100%. Why not? I think it's all about being able to tell a story, right? And elevator pitches are everything for founders, really. So, like, obviously, a lot of the time, people kind of think it comes down to their proven success and things like that, which it does. But often, the elevator pitch is really about storytelling, grabbing the attention of the audience. And sort of modern accelerator programs, charisma is something that really kind of works in grabbing the attention of people when you're up front and you've got potential investors looking to invest in that company. It engages people. So yeah, even though the piece seems quite light-hearted, like a founder's ability to kind of sell themselves to investors is everything, really, and humor is certainly a great tactic, I would say. I think it's, why not?
What do you think, Claire? Do you get people trying to make you laugh when they're pitching products to you? Do you think there's a role for comedy?
Well, I mean, I certainly think most CEOs up until this point wouldn't want to have people collapse into peals of laughter during their pitch. But I tend to agree with Joshua that I think that the ability to engage, to kind of break what can be, I would imagine, a pretty tough atmosphere, and to sort of tell the story in a way that cuts through is, I'm sure, really valuable. And I also think, if nothing else, it probably makes the person who's pitching think really differently about their message and why they're there and what they want to say, which sometimes just helps you get out of the kind of the box of, the story that you've told 1,000 times before. So I think it sounds really positive. I just hope the investors are ready for it.
What do you think, Paul?
Yeah, well, as I can just see now, everybody grappling for jokes and trying to tell a joke at the beginning of a pitch.
Could get out of control.
Yeah, like Christmas cracker type jokes. And but I think I'd agree with everything we said. It's more about the structure and the approach and telling a story, which is the most important thing. I mean, the old cliche is, isn't it? Those that tell the stories rule the world. So yeah, I agree.
I think it's tough, isn't it? If you're not naturally hilarious, it's quite hard to try and be funny. I mean, my children are constantly saying dad jokes if ever I try and tell any kind of joke. But I do think there's a lot to be learnt from the sort of techniques of the dramatic arts, and watching how people own a stage, and to the point you were sort of making, Clare, how they tell their stories and how they think about what it is they're trying to tell their audience. So I think this is fantastic. Though I have to say, Irish people have such charm and charisma anyway. Do they even need to be funny? All right. Well, that wraps up this week's FinTech Insider News. Thank you so much to my three guests today. You've been fantastic. Where can people find out a little bit more about you and your companies? Clare, and I think you get to talk twice, because how can people find out more about Zopa Bank, and how can people find out more about the Fintech Pledge?
Sure. So zopabank.com, or have a look for us on LinkedIn. And then for the pledge, go to www.pledge2025.org and you'll find all of the details, whether you want to join, whether you want to have a look at the impact report, everything is there. So please do check it out.
And Josh, where can people find out a little bit more about you?
Yeah, so you can go to our website at ComplyCube.com, or you can find us on LinkedIn, ComplyCube, all one words, 2 capital C's, or you can find myself on LinkedIn as well, Joshua Vowles-Dent.
And Paul, how about you and Cashflows?
Similarly, nothing original, but LinkedIn, myself, or Cashflows on our YouTube channel, where we've got lots of videos that show what we do, the types of things that we can offer to our customers, or visit us at cashflows.com.
Thank you. And as for me, Benjamin Ensor, you can find me on LinkedIn, and you can find out what the team have been up to at 11fs.com. Thank you all so much for listening. If you've liked what you've heard, please do follow the podcast. Leave us a review. Let us know what you'd like to hear about in the future. If you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. If you want to join the conversation and you're not on Spotify, just search for 11FS or Fintech Insider, or email us at podcasts@11fs.com. We also have a brand new WhatsApp community channel where you can get the inside track on all of our content. You can get involved via the link in the description below. So thank you all so much for listening. Thank you so much to my 3 great guests, and goodbye.